Hi, in this episode, I'm going to discuss a SRI, a Sustainable Responsible Impact Investing tool called AffirmativESG. And it is a customizable investment option for making an impact with your investments, for investing in line with your values. This is AIO Financial. I'm Bill Holliday. Thank you for joining us. We're still, well, I'm actually working in the office, but we're still in the COVID world here towards the end of 2020. This is a tool that was released this year, and I think it's a nice tool for people who cannot find what they're looking for through standard mutual funds or standard exchange traded funds. I'll go through the software with you or through the program. It's offered by First Affirmative, and currently you have to get it through a First Affirmative advisor. We're members of First Affirmative at AIO, and so we have access to this. I assume it'll become more available with time. I think it's a really attractive option or attractive tool. So they give you some options to begin with. And again, people use this differently. You could put all of your assets into this affirmative ESG investment, or you could treat it, what we do for most clients is we're treating it as a fund. So let's say you have $100,000, maybe 20,000 or 10,000 or one portion would go into this as like a separate fund. And it depends on the client. Maybe they can get all their needs met through standard publicly traded options, and great, then this isn't an issue. But if they have specific needs or want extra filtering, this is a cool tool. So I'm just going to pick build wealth. Is there a specific goal for this money? No, we're just going to say we just want an account to change your income. So they give you some questions to kind of determine your risk tolerance, and they're going to make a proposal with stocks and bonds. For this example, I'm just going to say we are going to use a stock portfolio is what we want to get out of this program. So I will just say we want an aggressive portfolio. If the portfolio lost 20% due to market conditions over a 12-month period, the investor would likely seize the opportunity and buy more. I would just like a stock portfolio for this investment that we're creating. So they have, I kind of like this chart, a trade-off between risk and possible future portfolio values. And if we go from, let me slide this. If we go from less volatile to more volatile, you can see how the range of returns is gonna be less certain the more aggressive you are. And that's exactly what we want in this. They also have a stress test. So if the market were to take, before moving forward, please click to see how a market crash would affect your portfolio. So if a market crash happens right before, like the year before you're gonna pull money out, of course, with an aggressive portfolio, it would make a bigger impact on your portfolio than a very conservative portfolio. But we still want very aggressive. For this portion, for this investment, indicate investor's primary source of income, and I'm just gonna say other. You don't want you to be overexposed. If you're in a publicly traded company, they don't want too much exposure in that company. Indicate if 5% or more of the investor's net worth is generated from real estate, a private business, risky stock. So I'm going to skip this because, again, I would just like a diversified portfolio. I'm not going to slant it. If I do have a lot of real estate, maybe I'd want less invested in real estate. Now, this is where the fun part comes in, where you can customize what your environmental, social, governance issues are that are important to you and create a portfolio through these questions. So this program is going to, at the end, give you about 300 to 400 individual stocks as your portfolio, and that'll be your portfolio. You can line item remove companies, you could add companies, But I'm going to say, what do we want to exclude? What do we want to include? So with animal rights, let's say factory farming will exclude, meat dairy producers exclude. You can start excluding everything you don't want, and you might find cruelty-free investing. Let's exclude the 10 worst. It can eliminate a lot of options. Like you may eliminate more than you want to eliminate, but maybe not. Maybe that's right up your alley, and you want to be very stringent on certain issues. It can limit, it can give you a less diversified portfolio. Fossil fuels, let us exclude coal, firms financing climate change. So that'll be all your big banks probably. Infrastructure, transportation, we'll leave that. Production of fossil fuels, yeah, let's get rid of that. Environmental issues, so other environmental issues, agricultural, GMOs, mining, nuclear utilities, I'm going to leave those. Renewable energy, let us include these. Water, I'm going to do wind, solar, I'm going to stick with that. Biofuels, geothermal, there's lots of options. Corporate behavior, best companies to work for, you can include. Best places for women include. Worst companies for LGBTQIA. We'll get rid of that. Worst companies, yes. Okay. Women board of directors, 55% or above. That's great. Lifestyle choices. So if there's things you want to exclude, I heard marijuana it's not a clear which path people are choosing. That can go both ways as far as including or excluding because you think it's going to help or not. I'm going to leave these all blank right now. Just an example. All right, military, definitely want to. Top arms producers, we want to not include, or I want to not include. Handguns, no. NRA affiliation, no. Military weapons, no. Okay. Prisons, that is a big one that I do not want any for-profit prisons in this portfolio. This is just an example. Next. All right, so it's filtering all that. Are there any companies you want to include? Yeah, here we go. So if we want to include a company, we can include it. And maybe it'll be in there. You can actually go look at what the portfolio is and then later exclude companies, or if you're missing something that you want to include it. You can adjust it any which way you want. Include, exclude certain companies. Be Bank of America, BAC. Let's just pretend, I don't even know if that was going to be on the list, but if it was on the list and I want to exclude it, let's exclude it. Wells Fargo, yeah, let's just say we want to exclude those. That's it. They're going to build the investment solution. This program has an expense ratio of about 0.4. I think it is 0.4. It does go down with more assets. So I believe that's for the first 500,000, and this may change with time, but currently 0.4%. So it's really competitive with other mutual funds, even with exchange traded funds. And First Affirmative is very active in engagement with companies. They propose shareholder resolutions. They team with other funds to put up more shareholder resolutions or to engage with companies to make positive changes. So they are really advocating a lot or doing a lot of work on that side. So 0.4% would be the expense of the investment, and then the advisor is charging a fee, but that's independent of the investment they use. For fee-only advisors, that's an independent of the investment. See what happens if you change. Okay, so we could change something. I'm saying initial deposit of $10,000. I believe the minimum investment is $5,000. So that's for this customized portfolio, this separately managed account. It's a pretty low minimum. This used to be, they used to have a similar structure that was $200,000 minimum. And most of these separately managed accounts where you have all these individual stocks, it is rather high, the minimum. But this is nice. And this is why I say it can be used just like a separate mutual fund that you want customized. Now, because you can customize it so much, you may even want more assets in this portfolio. Projected returns, great. Show the market crash. Sure, we'll show it. Recommended portfolio, and then this is kind of cute. They have different slivers. So this is developed foreign markets, ex-US, and they'll show you what companies make up that slice in this proposed portfolio. Mega US companies. Now you may see some companies and say, wait, I don't want Johnson & Johnson or I don't want Amazon. We can cherry pick those out or maybe be more careful in our selection. If they have issues that we didn't want in that screening, those questionnaire, we can take our time and re-look at that. So we're not committed to anything at this point. Mid-cap stock, small, well, real estate investments, and that's why they're asking, maybe they're saying 10% in real estate. Well, we could definitely adjust that and have less exposure in real estate and large cap, US large cap stocks. What did I say before? Oh, mega stocks. Large cap, again, check the list. If there's anything that's an issue, they print out, there's an Excel spreadsheet at the end where you get all the names of companies and all the tickers. So you can go through it at the end. But this is kind of a quick, you're getting the percentage exposure, because that could be an issue too. I mean, you may find small cap stocks. Oh, and you can see what the holding is. First Hawaiian Inc., not thrilled with that company, but I only have 8% of my total portfolio split between all these companies. And actually, the spreadsheet will give you that too, the exact percentage in each company. 4% of the exposure. So they're doing about 4% in these, what is this, 20-ish options. So probably 25 options. So that would make sense that this is 4% of the 6% is exposed in each of these companies. So again, that could help weight. Maybe you still want nothing to do with that company. Great, you can exclude it, no big deal. But if it's a small holding, maybe it's not that big of a deal. Bond funds, they're putting in a bond fund, and then emerging markets. So these are the companies they're selecting for emerging markets. For those filters that I just chose, so preferences added, the inclusions, we said yes, solar, yes, wind, yes, Tesla. I'm not recommending this for anyone. This is just an example portfolio, so don't copy this. And then the exclusions, these are the areas with nice little drawings of what we're trying to avoid. I think that's great. And then they have, First Affirmative has its sustainability exclusions as well. And then we threw in a couple of banks to exclude as well. Whether they were going to be in this list or not, I'm not sure. And then we're done. We can download this portfolio. And so here's the 300 stock, 300 to 400 individual stocks. They have one bond fund, and boom, you have your portfolio. Again, this is, and then if you want to go forward, you review the investment policy statement, look at your goals. Again, you can do this a lot of different ways. I'm actually going to go back, restart questionnaire. You can set up different goals. Again, maybe you have a target date and that you want this to move more conservative as you get close to it. Again, I'm going to keep this very simple, no specific goal, no changes in my salary. Again, you'd want to have a more conservative portfolio if there's a potential to tap this money. Again, I am thinking of this as a piece of a portfolio, not necessarily the entire portfolio, although for many people, this can be your entire portfolio here. And you may want to break it up into this portion is saved for a goal. This portion is saved for just long-term wealth growth. This portion is, for education or something else. So again, I'm going to go with a high risk tolerance, not mess with the bond. I'm going to just skip these, not mess with the bond pieces. And again, these are the big questionnaire issues that we're looking at. Do you want to just get out of pharmaceuticals? Cruelty-free, I like getting rid of factory farming, definitely. And we can look at it again with we are definitely excluding. Yeah, I mean, again, I could go through this and maybe pick more, exclude more, or maybe including more. Just going crazy on the inclusion side, because that is going to be our future, and I want to take advantage of that. Utilities, do we want to avoid? I'm going to go with that. Corporate behavior, let's try some of these. Best companies to work for, sure. Oops, sure, throw some of those in. Best workplaces for women, sure. Boards of directors, women on boards of directors, 55% or more, sure. Fair labor members, yes. And the worst companies, no. It's a little tricky, you kind of got to read. Yes, we want to avoid that way. Lifestyle choices, I'm going to leave it blank. Soda producers, I'm going to get rid of. Opioid, I don't know. I'm going to get rid of tobacco. In this example, again, I'm just making up an example. Marijuana, I kind of like that it's legal because I don't like the jail population, but not a big fan. I mean, for me, I don't know, whatever anyone else wants to do, that's fine with me. I have enough trouble focusing as is. I mean, yeah, whatever. I'm done with that topic. All right, handguns we're avoiding. All right, I've already went through this. Top producers we're getting rid of. Yeah, not a big fan of handguns. Controversial weapons, let's not do those. All right, and then I really, even if we're doing a different scenario, I'm skipping that. But just I like the areas there. You can, with your advisor, of course, you can dig in deeper. This is a first tier. You can actually take the companies that you come up with, your portfolio, and plug them into something like your stake. I actually am going to do that. I'm actually going to do that. Should I put pause on this? Well, all right, let me run through this. I'm not going to exclude or include anything. We'll just go with those filters. We'll create our portfolio, and then I'm actually going to download the portfolio and I'm going to plug it in your stake and see what they say. I might have to change my screen sharing. Yeah, I'll just change my screen sharing to include that program. But this is, I think it's wonderful for a 0.4% expense ratio for this program. We mostly see institutional share mutual funds in the 0.4, 0.5%. Exchange traded funds, which aren't going to be engaging as much as we're going to see here. So here's what I ended up doing with the preferences. We have a lot more inclusions. I went nuts on the alternative energy. On the exclusions, you can see what was chosen with these really cute drawings. And we're good. I'm downloading this portfolio. And then I am going to throw that portfolio into your stake and see how it comes out. All right, I am back. I put that portfolio that we created into the Your Stake program to evaluate their impact. You could see it's a pretty positive impact. They actually have a couple different screen options. I'm going to go through this one first, though. Your contribution, so tobacco, since we did exclude tobacco, you'd expect that we're minus 100%. I like what your stake has done. They put a check mark to show that the category is doing well. So you can see we're getting a mix of companies that are doing well and then not doing well in some of the other areas. Prison industry doing pretty well. Women on boards, CEO pay, those are not that great. Political spending disclosure, some of these financial crimes, these three categories are not doing well compared to a benchmark. I am going to pick out a couple of these. So weapons industry exposure, we did well. We should see, yes, that we're in great shape with our holdings. That makes sense with the screening we put. Clean energy companies. All right, I like this. Fossil fuel industries. Let's just see what we have. Those all look very good, mostly green energy. Wonderful. Clean energy companies, deforestation, that's good. Strong climate commitment. So clean energy companies, you can see quite a few that do not meet their standard. So this would be, if this is an issue, okay, so we did include utilities. And so that's going to show up. Yeah, that's good to see. Maybe we should include utilities if that's an issue or not. But, or yeah, banks, if they're financing. So if this is an issue, then we should be, wonder if they let you click on, no, you can't go any deeper than that. This is as deep as you go for your stake evaluation right now. Strong climate commitment. Yeah, some of these companies are not showing up as having a strong commitment. I assume this is a long list here. There are many that are, so that's good. I mean, it's good that there's some on both ends of this spectrum. I wonder about the other. There's probably also some companies, yes, on the positive side. Okay, that's good. I guess it's pick what issues are important to you for sure, and then evaluate based on that. I'm going to pause my screen sharing for a second, and I would just like to go back to my dashboard, and here's just a different presentation of the same thing. So health issues, weapons industry, tobacco, okay. Environmental issue, that's a big one for me. There's also, we can customize this and add, there are several other categories that you can present. Equal opportunity, prison industry, right? Migrant detention centers, that's good with this portfolio. CEO pay didn't come out too well. I wonder what companies, Tesla, all right. Okay, that's interesting. There's a lot of them that have issues, and then the slides down, and then we should get companies that are better at that. Yeah, great. Oh, and then they're showing you what they're comparing it to, the Russell 3000 in this case. Financial crimes, yeah, that's not good. All right, so this is just another way to evaluate it. So first affirmative is giving you their first over, and then you may want to be more stringent. You may want to cherry pick some of those companies out. So you're going to have 300 individual companies, and you can do further filtering, of course. Then they'll rebalance. They are very tax conscious, so they're taking capital losses, being very careful about capital gains. Again, looking at some of these categories, I think they are working to get more lists to include or exclude, and that'll help with this process as well. Because it is hard going through the individual companies. There's a lot of companies you're looking at, foreign, domestic, small, emerging markets. It's hard to have a good grasp on how responsible all those different companies are. But again, another plug for First Affirmative is that they are very active with shareholder advocacy. So they'd be more comparable to a very active mutual fund, kind of like a Calvert, Domini, Trillium, that are engaging with companies, trying to make changes. And again, we're only at a 0.4 expense ratio, percent expense ratio, whereas this isn't as comparable to just an ETF or just an exchange traded fund that they'll do minimal screening, avoid a few things, and then they're not going to engage. Generally, they're not going to engage with companies to make positive changes. So your impact is a lot less. I really like this customized option that they offer. So I think that's all I wanted to express right now or show right now. Please let me know if you have any questions. Again, this is AIO Financial Impact Financial Planner Podcast as well. My name is Bill Holliday. If you need help with any part of your financial situation, feel free to contact us for a free upfront meeting, aiofinancial.com. You can find a link to set up a meeting and we can go over things. Everything's virtual right now. We'll see. I imagine a lot of clients will stay virtual even when this pandemic subsides because it's quicker, convenient. It is nice to be face-to-face now and again, but we'll see how people react or respond to this. Okay, hope you're all doing well. Thanks again for joining me. I really appreciate it. If you like these videos, podcasts, please subscribe. Please give a rating, write a comment, give a review. That all helps so that other people can learn about how to make an impact with their investments. All right, thanks a lot. Bye.